Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management, LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management, LLC may maintain positions in the securities discussed in this podcast.
Hello, everybody. This is the Northbound Wealth Podcast with your host, Brent Foster. This is your weekly market insights, November 24th, Thanksgiving week. Happy Thanksgiving. I hope you all spend time with the loved ones that are in your life and that you get that quality time to give them hugs and spend some time reflecting on the year and how God has been good to all of us. Anyway, let's dive in. The S&P 500 index fell 1.95% this week in a technology-led decline as the September unemployment rate came in higher than expected. That was last week, okay? So the market benchmark ended Friday's session at 6,602.99. It is now down 3.5% for November, but up 12% for the year. That's a little bit of an anomaly because November is usually an up month. September payrolls in the U.S. rose by 119,000, more than the 51,000 increase expected in a Bloomberg survey. The unemployment rate edged up to 4.4% and the highest since October 2021, while Wall Street had expected it to hold steady at 4.3%. The report was delayed by almost 7 weeks by the record-long federal government shutdown, which ended last week. Investors are weighing what the data might mean for the Federal Reserve's December policy meeting. Minutes from the October meeting showed policymakers held strongly differing views on the next rate decision. I noticed a tweet that actually was released today. Today's November 25th by President Trump. He's looking to replace Jerome Powell by Christmas. Whether or not that's actually going to get done or not is another thing, but it looks like he's looking to try to push the federal government to lower interest rates sooner rather than later. Technology led the sector declines this week, falling 4.7%, followed by a 3.3% slide in consumer discretionary and a 3.1% drop in energy. Industrials, financials, utilities, materials, and real estate also fell. Advanced micro devices shares fell 17%, and Micron Technology dropped 16%. NVIDIA shed 5.9%. Despite stronger than expected fiscal third quarter results. Wedbush described the sell-off as another, quote, deep-seek moment, end quote, noting investors' nerves around the sustainability of the AI build-out. Among the top decliners in consumer discretionary, Home Depot shares fell 5.25% this past week. The home improvement retailer's fiscal third quarter earnings unexpectedly fell, and the company lowered its bottom line outlook for the full year. Now, I will say this. It unexpectedly fell, but there is an expectation that they would fall because the housing market across the country has been locked up. Hopefully, this upcoming spring will be a different story. The energy sector's drop came as crude oil futures also fell in the week. EQT Corp shed 4.8% and Marathon Petroleum declined 4.7%. Communication services climbed 3%. Healthcare rose 1.8% and consumer staples edged up 0.8%. Alphabet, also known as Google, shares rose 8.4% as its Google unit unveiled Gemini 3, its latest artificial intelligence model. They also announced a deal with Meta that's going to compete for TPUs instead of GPUs against NVIDIA. So Alphabet's trying to produce their own chips. This week, the market will be closed on Thursday for Thanksgiving holiday, followed by a shortened Friday session known as Black Friday. So it's like a half day, if you will. Earlier in the week, economic data will include September retail sales, September producer price index. Both reports were delayed by the government shutdown. Y Charts data shows that year-to-date trailing number for the Dow Industrial Average is up 9.14%. MSCI EFA index, which tracks developed overseas stock markets, is up 24.55%. The S&P 500, which is in the U.S., is up 12.45% on the year-to-date trailing number. And the NASDAQ which is the tech-heavy space, up 14.99%. Not bad years shaping up. The 10-year Treasury rate is at 4.06%. That's down from the 4.33% 3 months ago and 4.43% a year ago. So this week, we've got retail sales, which is September data on Tuesday, Case-Shiller Home Price Index, September numbers. All of this is mostly September because the government was in shutdown, but business inventories, consumer confidence, pending home sales, tracking all that for you. Weekly jobless claims, durable good orders, September again. And then Thursday is the Thanksgiving holiday. Chicago Business Barometers on Friday. And notable companies reporting earnings would be Allegiant Technologies, Analog Devices, Dell Technologies, Autodesk, Workday, and Deere Company this week. So we'll be tracking that for you. And this week's tax tip of the week, outstanding tax bill, consider an offer to in compromise with the IRS. An offer in compromise is a federal tax program that allows taxpayers to enter into agreement with the IRS to settle their tax debt for less than the amount they owe. This agreement's an option when taxpayers can't pay their full tax liabilities or when paying the entire balance owed would cause financial hardship. The goal is to compromise that suits the best interests of both parties. The IRS considers various circumstances when reviewing OIC applications, including the applicant's number one, income, 2, expenses, and 3, asset equity. There's also an application to apply for an OIC. Taxpayers who meet the definition of low-income taxpayer don't have to pay this fee. This information is not a substitute for individualized tax advice. Please discuss your specific tax issues with a qualified tax professional. And this tip was adapted from irs.gov. Stay tuned for the next segment. We've got a good show for you. So AI leadership and market anxiety. 2025 has been defined by an increasingly concentrated market led by a handful of mega cap names. The top 10 holdings in the S&P 500 now comprise roughly 39% of the entire index, a level of concentration that raises questions about the index's durability and risk. A key factor of this concentration has been the rapid expansion of artificial intelligence. The largest companies in tech and cloud computing continue to scale their AI capabilities, building more data centers and securing the hardware needed for the next generation models. With AI investment accelerating and leadership narrowing, investors are asking whether this reflects a lasting productivity shift or early stages of another tech bubble. The comparison that is most often made is to the late 1990s. On the surface, both periods feature a breakthrough innovation, concentrated leadership, and rising expectations. However, headline similarities can overlook structural differences that drive today's cycle. To understand today's environment, it's worth revisiting what actually defined the dot-com era and how this cycle differs from it. The dot-com blueprint. Well, the dot-com era provides context, but it doesn't mirror today's market. The late 1990s were marked by enthusiasm that pushed prices far ahead of reason, a setup that helps clarify how different today's environment is beneath the surface. In the 17 months leading up to March 2000, the NASDAQ climbed more than 230% as investors flooded into anything with an internet story. I know that I did during that time in the mid to late 90s. Prices went vertical while earnings and cash flow barely moved. So that was a key component of the market and the tech bubble back then. A problematic climb that disconnected from financial reality. Prices accelerated far faster than underlying conditions. Profit expectations rose without matching earnings, and capital concentrated in unprofitable speculative tech names. Consider Pets.com, which raised $82.5 million in its IPO, yet declared bankruptcy just 9 months later due to lack of revenue, or eToys, which racked up $247 million in debt and fell from $86 to 9 cents per share before filing for bankruptcy in 2001. And today's environment looks very different. Corporate earnings continue to rise, and forward expectations are increasing. This cycle is supported by real profitability, not speculation. This doesn't eliminate uncertainty or guarantee a smooth path forward, but it does show that the current landscape is more than just euphoria. Before calling something a bubble, it's worth asking whether prices are outrunning earnings. Right now, the evidence points in the opposite direction. There's always a reason to sell. So even in strong markets, investor sentiment rarely feels stable in real time. Every year brings new headlines that prompt investors to question their positioning, even when the data tells a different story. Over the last several decades, investors have navigated recessions, political disruptions, debt crises, inflation spikes, pandemics, and more. Despite the frequency and severity of these events, markets have recovered 100% of the time. So, headlines and shocks regularly prompt calls to de-risk portfolios, yet the market's long-term trajectory has continued upward through each episode. Risks tied to AI-driven speculation, high index concentration, or broader macro uncertainty may feel uneasy in the moment, but long-term outcomes have favored staying invested through uncertainty rather than reacting to it. So today's fundamental differences. Today's AI leaders aren't early stage businesses built on speculative revenue models. They are the largest and most profitable companies in the world, deploying record levels of revenue and free cash flow into AI infrastructure. So scale. They have an ability to do that. Expanding revenue bases provide the stability needed for long-term AI investment, and profitability is the second, with robust free cash flow, which enables self-funded AI development, unlike the dot-com era. And then transitioning and gearing, Federal Reserve Chairman Jerome Powell commented on this at the latest FOMC meeting, stating that this cycle, and he says, quote, is different in the sense that these companies, the companies that are so highly valued, actually have earnings and stuff like that, end quote. The companies committing billions of dollars to AI are doing so because they see durable demand from enterprises, developers, and cloud customers. So the case in point is this. Satya Nadella at Microsoft, the CEO there, says, quote, more than any transformation before it, this generation of AI is radically changing every layer of the tech stack, end quote. And Mark Zuckerberg at Meta, he's the CEO there, quote, we're also going to invest hundreds of billions of dollars into compute to build super intelligence. We have the capital from our business to do this, end quote. And Jensen Huang, NVIDIA CEO, said, quote, this is the industry. This is that industry we're talking about. This is the industrial revolution, end quote. Their public comments consistently frame AI not as a short-lived trend, but as a defining technological shift for the next decade and beyond. So, navigating the narrative. Bubble concerns tend to surface quickly, especially when innovation outpaces investor comfort. Even in the most challenging periods, markets have recovered, and the conditions that shape those downturns do not match the environment we see today. Diversification plays an essential role in guiding clients through uncertainty. When equities experienced sharp drawdowns in 2025, bonds provided meaningful protection. Clients can also highlight the benefits of global diversification, particularly in a year where international markets have shown renewed strength. Emerging economies and developed markets outside the U.S. have both outpaced domestic equities, helping address concerns about reliance on a handful of mega cap names. It helps when the dollar depreciates as well relative to foreign currency. That also helps the international markets. So helping investors understand this reduces uncertainty and keeps decisions aligned with long-term objectives. In a year defined by rapid innovation and constant debate, the ability to translate complex narratives into steady, informed guidance remains one of the most valuable services an advisor can provide, a financial professional can provide. And you would like to learn more about how to allocate portfolios across the markets, do not hesitate to reach out to Northbound Wealth Management. And this article was from Y Charts on November 20th, 2025, why the dot-com comparisons fall short in 2025. So thank you, Y Charts. They're a great provider for research and information and trading data, market data for Northbound. But yeah, not affiliated with them, but it's just really good stuff that I wanted to share with everyone. So thanks for listening. Hey everyone, I just want to make a comment just saying that I think the equity markets, based on what I'm looking at between now and year end, we're going to get a rally, Santa Claus rally. We might get some sideways chop in the mix there, and there's going to be a lot of focus on fourth quarter numbers as well as the Fed and Jerome Powell, if what they're going to do at the Fed, who the future leadership's going to be, and how they're going to approach quantitative easing or tightening fiscal and monetary policy, probably cutting interest rates. That's probably going to be back on the table. The market is going to price that in as market participants head into the end of the year and look out into 2026. So, as a reminder, the market is a discounting mechanism, looking about 6 to 9 months out into the future, seeing where things are going to shape up, and the focus is really going to be on the consumer, if they're going to be in good shape or not during this holiday season. So everybody's going to be working on their analysis of how the consumer is holding up and what the housing market does, heading forward into the first quarter of next year and the second quarter of next year. So keep that in mind as you are looking to set goals for next year and allocate capital within liquid portfolios or investment assets. All right, stay tuned for the next segment. This is more of a technical segment, and I'm going to go over the American Association of Individual Investors Journal, October 2025 edition. There's an article that I want to cover having to do with the McClellan Summation Index, or the McClellan Oscillator. I know this is a little more technical for those of you who are not interested. Don't tune out. You might pick up some things, but those of you who are interested, this is I thought a well-written article. I won't go through it too deeply, but I do want to pull and explain some things on how to use the McClellan Oscillator from a technical perspective. And this article was written by Wayne Thorpe. He's a CFA. He was a senior financial analyst and vice president at the AAII, which is the American Association of Individual Investors, again in October 2025. And he was saying, looking beyond price trends with the McClellan Oscillator, it's just one indicator among many. It's one that I use quite often. And that's why, and I've mentioned it on the podcast before, I figured it'd be a good time to go over it, given that a lot of people are looking for momentum and indicators on which direction the market's going to go. And this oscillator helps cut through a lot of the noise. So Wayne goes on, he says, the most expensive mistake investors make isn't picking the wrong stocks. It's misreading market conditions. As market concentration reached extreme levels in 2024, with just 7 mega cap stocks driving the entire S&P 500 index higher while the average stock declined, many investors continue buying aggressively despite narrowing market participation. The 55-year-old breadth indicator could have warned them. So it is 55 years old. The McClellan Oscillator, developed by Sherman and Marion McClellan in 1969, measures market participation beyond what price indexes reveal. While the S&P 500 can rise on the strength of its largest components, the oscillator exposes whether that strength reflects broad-based buying or narrow leadership. This distinction often determines whether rallies continue or reverse. The oscillator calculates the difference between the 19-day and the 39-day exponential moving averages, or the EMAs, of net advancing issues, which is advancing stocks minus declining stocks. EMAs, or exponential moving averages, weight recent data more heavily than simple averages, making the indicator more responsive to changing conditions. Modern implementations use ratio-adjusted calculations to account for the changing number of listed securities. The formula produces oscillating values around zero. Positive readings indicate that recent market breadth exceeds the longer-term average, meaning more stocks are participating in market moves. Negative readings suggest deteriorating participation, often preceding broader market weakness, even when major indexes continue to rise. So there's a whole calculation that goes into this. I won't get too far into the weeds, but The oscillator consists of several components that work together to create a sensitive measure of market momentum. A crucial limitation of raw advance or decline data is that the total number of stocks trading on exchange changes over time. The New York Stock Exchange has grown from around 2,000 issues in 1990 to over 3,500 in 2000, settling at roughly 2,800 issues today. Securities, that is. The first component adjusts for this limitation, but exponential moving averages reduce lag compared to simple moving averages by applying more weight to recent data. The weighting multiplier, and it goes through all of that 19-day and the 39-day. And then what ends up happening is the final calculation subtracts the longer period average from the shorter period average and multiplies by 1,000 to eliminate decimals. So, working through a practical example, consider New York Stock Exchange data from a volatile period. On a day when 1,847 issues advanced and 1,331 declined, so obviously you have more advancers than decliners, the raw net advances is plus 516. If you want to do the math in your head, go for it. However, applying the calculation, this means so you basically take 1,847, subtract 1,331, and divide it by 1,847 plus 1,331, which equals 516. Divide that by 3,178, the total issues. You get a ratio of 0.162 or 16.2%. This means that on the trading day, net advances issued represented 16.2% of all New York Stock Exchange stocks that either advanced or declined. Without additional context, the raw net advances value of plus 516 is meaningless. So this figure feeds into both EMAs. If the previous day's 19-day EMA was 0.140 or 14%, the new 19-day EMA becomes 0.142. A similar calculation updates the 39-day EMA. The final oscillator reading equals plus 7, or 0.142 minus 0.135 times 1,000. This indicates the most positive momentum in market breadth. It really measures a lot of breadth. So not bad breadth, but breadth. The McKellen oscillator is sometimes described as the moving average convergence or divergence, or MACD, of the advanced decline, or AD, line, which accurately captures its function. Like MACD, it identifies momentum changes through the interaction of the two moving averages. So I talk about the MACD oscillator all the time. I use that calculation through the software that I use to analyze equities and the movement of markets. So positive versus negative territory, the oscillator moves between positive and negative territory based on crossovers between the 19 and 30-day exponential moving averages. Positive readings indicate that market breadth exceeds the longer-term average, while negative readings suggest deteriorating participation. Extended periods in positive territory typically correspond with strong uptrends in the underlying index. Conversely, sustained negative readings often accompany significant downtrends. However, the oscillator can be quite volatile due to its EMA construction, which responds quickly to individual data points. So, unlike past podcast episodes, I've talked about overbought and oversold conditions. So, like many momentum oscillators, the McKellen oscillator indicates possible overbought conditions when reaching the 70 plus 70 to 100 range, and possible oversold conditions in the negative 70 to negative 100 range. These traditional thresholds have explained somewhat in more recent periods, with extreme readings now often reaching plus 150 or beyond during periods of intense market stress. So divergences represent the McKellen oscillator's most powerful application. So a divergence occurs when an indicator moves in one direction while the index moves in the opposite direction. And there's this thing called a bearish divergence, where bearish divergences develop when an indicator makes lower highs while prices make higher highs. Think of this as the market putting on a brave face while losing stamina underneath. So a clear example unfolded during February and March of 2024. The S&P 500 kept climbing to new highs week after week, which is exactly what you'd want to see in a bull market. But beneath the surface, something concerning was happening. The McKellen oscillator, based on the New York Stock Exchange data, was making progressively lower peaks. Each time the S&P 500 hit a new high, fewer New York Stock Exchange listed stocks were participating in the advance. Here's how to spot the pattern. Draw an imaginary line connecting the oscillator's recent peaks. If that line slopes downward while the price index continues to rise, you're seeing a bearish divergence develop. It's like watching a runner who keeps moving forward but is clearly getting tired. Eventually, they'll have to slow down. The divergence in early 2024 was confirmed when the oscillator moved into negative territory in March of 24, signaling that the broad NYSE participation had turned negative despite the S&P 500 strength. This warned that the rally was running on fumes. Sure enough, the broader market subsequently weakened as the narrow leadership became unsustainable. The key insight is that when fewer and fewer stocks participate in market advances, those advances become vulnerable. The McKellen oscillator reveals this weakness before it becomes obvious in price action. Bullish divergences. So bullish divergences occur when the indicator makes higher lows while prices mark lower lows. In August 2023, the New York Stock Exchange Composite started a pronounced downtrend, but the McKellen oscillator began making higher lows. This bullish convergence was confirmed when the oscillator moved into positive territory in early September, followed by the NYSE Composite gaining over 4% in less than 3 weeks. The key to successful divergence analysis lies in patience and confirmation. Patterns are much easier to identify after the fact when they are developing. Avoid identifying patterns where none truly exists and wait for confirmation before acting on apparent divergences. There's a lot of heady stuff there. And with that, I'll wrap up that little segment of the technical analysis spotlight on the McKellen oscillator. Anyway, we use that here at Northbound Wealth Management to analyze where market trends are going, trying to get an indication of where things are headed despite where price action is taking the market. Year-end giving strategies. This will be out on the blog. Key takeaways: a third of annual donations, about 1/3 of all charitable contributions, are made in December. Donating before December 31st may offer tax advantages. New rules starting in 2026 via the One Big Beautiful Bill Act, or the OBBB, may affect deductions for high earners and corporations. Consider tools like IRAs, donor advised funds, appreciated securities, and bundling donations. Because of complex rules and evolving tax laws, working with a financial tax and legal professional may help you make the most of your charitable giving strategy. Again, a third are made in December, driven by the holiday spirit. You're in tax prep. So if you're considering making a charitable donation, you're not alone. Nonprofits often receive 17 to 31% of their annual online revenue in December, with 47% of that revenue coming in the last week of December and 20% coming in on December 31st. There are both emotional and strategic reasons Americans wait till the end of the year to fund their favorite causes, including a combination of cultural norms, tax incentives, and the spirit of the holiday season. December is synonymous with the holiday season, which often centers around giving, gratitude, and community. Many people are naturally inclined to help those in need during this time. The festive atmosphere often inspires a season of giving, where people are reminded of the importance of family, togetherness, and goodwill, which can translate into increased charitable actions. December also offers an opportunity for people to reflect on the year and their own successes and failures, leading to a desire to give back. Individuals may feel grateful for their blessing and want to share with others in need. Charitable acts allow them the opportunity to finish the year on a positive note and giving back to the community. Nonprofits are aware of the emotional triggers as the year comes to a close and ramp up their giving campaigns to capitalize on the expected generosity. From a strategic standpoint, Americans know that charitable contributions made by December 31st may result in tax advantages. This may create financial incentives, especially for high net worth individuals and businesses, to make charitable donations at the end of the year that also can have tax benefits, of course. Keep in mind, this information is for informational purposes only and is not a replacement for real life advice. Consult your legal, tax, and accounting professionals before modifying your charitable giving strategy for tax reasons. So, regardless of the motivation, Americans are generous, of course. For 2024, total charitable contributions were over $590 billion. That's a 6.3% increase from the prior year and the largest increase since the pandemic year of 2021. Giving Tuesday, which takes place on the Tuesday after Thanksgiving, has also evolved into a global movement that encourages year-end donations, particularly through social media and online platforms. Nonprofits raised a record $3.6 billion on Giving Tuesday in 2024, a 16% increase from 2023. This year, Giving Tuesday, not to be confused with the spending holidays of Black Friday or Cyber Monday, is December 2nd. So, individuals donate most of the nation's charitable contributions. That's by a lot. In total, 66% of last year's giving came from individuals, an 8.2% increase from the prior year. The closest runner-up was foundations at 19%, followed by bequests at 8% and corporations at 7%. The bequest slice of the charitable contribution pie may be set to expand in the coming years as the great wealth transfer from older generations continues. Cerulli Associates projects that the wealth transferred through 2048 will total $124 trillion is expected to flow to heirs, while $18 trillion will go to charity. So where are the contributions going? In 2024, nearly half of all charitable dollars went to religion. That's 23%, human services, 14%, and education, 14%. The rest was spread among foundations, 11%. Public society benefit, 11%. Health, 10%. International affairs, 6%. Arts, cultures, humanities, 4%. Environment or animals, 3%. And the rest went to other small categories. The largest year-over-year percentage increase in donations went to public society benefits, international affairs, and education. So how do you choose a charity to support? With so many charities seeking your support, choosing which ones to donate to can be difficult. By researching and preparing, you can find a charity that aligns with your values and uses your donations wisely. Research the charity, obviously. Use publicly available sources to understand what a charity does and who it serves. One factor to consider is the group's transparency and accountability in financial reporting and program effectiveness. You can also get information on websites such as Charity Navigator, GuideStar, or Better Business Bureau, Wise Giving Alliance. Understand the mission and impact. Another factor to consider is whether the organization's values and goals align with yours. Look for a clear and measurable impact on the community or cause that they serve. Consider the scope of their programs and services. Consider your interests and passions. Your interests and passions can help you find a cause that resonates with you and inspires you to make a difference. Getting involved. So many charities offer volunteer opportunities or ways you can participate in their events and campaigns. These opportunities can give you an even greater understanding of the charity's impact while helping you build a deeper connection to the cause. How does the One Big Beautiful Bill Act impact charitable tax deductions? In general, the new tax provisions in the OBBB may enhance the tax benefits of charitable donations. However, the Act does introduce limits for high earners. Here are some of the key changes in the tax treatment for charitable donations. Starting in 2026, the law allows for a new charitable gift deduction for taxpayers who do not itemize up to $1,000 for single filers or $2,000 for married couples filing jointly. Those who itemize can only claim a tax deduction if their qualified charitable contributions exceed 0.5% of their adjusted gross income. For taxpayers in the highest brackets, the value of charitable deductions will be limited to 35% of the contribution amount, even if they are in the 37% marginal tax bracket. This means that a $1,000 donation would yield a $350 deduction instead of the previous $370. Corporations will face new rules, including a 1% floor for charitable contributions. The purpose is to prevent excessive tax breaks while still encouraging corporations to give to charity. You may want to consider these new provisions when thinking about your charitable contribution strategy. If you're a high earner or have a business, you may need to address how your current strategy works or conflicts with the new rules. What are some of the tax-advantaged charitable giving strategies? Well, as financial professionals, we've worked with many clients over the years to help create a charitable giving strategy. We often coordinate with our clients' tax professionals like CPAs and estate planning attorneys to help align overall goals and approach. Here are some of the ideas to consider when you're building a strategy. Consider using your traditional IRA to make qualified charitable distributions. If you are at least 70 and a half years old, you can donate up to $108,000 in 2025 from your IRA as a qualified charitable distribution. Each spouse can contribute that amount, equaling $216,000 if you're married. The distribution may satisfy your annual required minimum distribution since it is not reported as income. The RMD won't be reported on your personal tax return. Current tax law raised the standard deduction, which has influenced some RMD decisions. Donating appreciated securities. So, suppose you are considering using the proceeds from appreciated securities to make a charitable donation. If that is the case, consider the tax consequence of donating the securities rather than selling the position and donating the cash. Donating depreciated securities. On the other hand, if you have depreciated securities, you might want to explore the tax consequences of recognizing those losses before making the gift. That approach may allow you to hold the losses, which could then be used to offset capital gains in the future. Consult with your financial professional. So, before modifying your investment strategy for tax reasons, your financial professional may want to speak with your tax, legal, and accounting professionals before moving ahead with any strategy that generates losses in an account. Donor advised funds, or DAF, acts like a charitable investment account for the sole purpose of supporting the charitable organizations you care about. You can contribute cash, securities, or other assets to a DAF and are generally eligible to take an immediate tax deduction. You can recommend grants to the eligible IRS qualified public charity of your choosing through the DAF or donor advised fund. And some donor advised funds are considered mutual funds. They're only sold by prospectus. So keep in mind information on risks, expenses, charges, and they should be reviewed carefully. Talk to a professional if you have questions. Charitable remainder trusts. So charitable remainder trusts are irrevocable trusts that let you donate assets to charity and draw annual income for life for a specific period. You can transfer property, cash, and other assets into an irrevocable trust. The trust pays income to at least one living beneficiary and continues for a specific term or the life of one or more of the beneficiaries. At the end of the payment term, the remainder of the trust passes to a charitable organization or organizations. You can also use up to $54,000 of a qualified charitable distribution from your IRA to make a one-time donation to a charitable remainder trust. Then there are charitable lead trusts or CLTs. The CLT is used for both philanthropic and financial purposes. Through this type of trust, you can provide income to one or more charitable organizations for a specified term, after which the remaining assets are then transferred to others, such as family members. The structure may allow you to achieve charitable goals while potentially reducing estate and gift taxes. Income to the charity can be structured as either fixed or variable, depending on the type of CLT. Fixed annuity payments can provide predictable income to the charity, while unit trust payments, which fluctuate based on the trust asset value, can potentially offer growth in the charitable contributions over time. So, using a trust to help your charitable initiatives involves a complex set of tax rules and regulations. Before moving forward with the trust, consider working with a estate planning attorney or a professional who's familiar with the relevant rules and regulations. Bundling charitable deductions. So, to itemize deductions with the higher standard deduction threshold coming with the OBBB, you might want to consider bundling or make your charitable contributions every other year. This strategy could help you accumulate a larger pool of deductions that exceed your standard deduction amount. For example, in year one, you could take the standard deduction with little or no charitable giving, holding off on the amount that you would have given until year two. And in year 2, you would then donate the equivalent of 2 years' worth of charitable contributions and possibly itemize your deductions. So your impact is about effectiveness and timing. Thoughtful philanthropy can create a lasting impact while enhancing your overall financial strategy. We can help you explore possibilities from structuring gifts effectively to weighing different approaches and ensuring your philanthropy aligns with your broader financial strategy. If you're interested, feel free to reach out to us and turn your charitable vision into an action for 2025 and beyond. Few things we can teach our children are more valuable than the discipline of saying no. We must model delayed gratification and teach the discipline of avoiding expenditures when money could accomplish the higher purpose by being given away, saved, or used more wisely. Self-control is one of the highest Christian virtues, Galatians 5 and Titus talk about. In the Bible, the preacher told this story. One day I asked the Lord, "What's 1,000,000 years to you?" God said, "It's only a second in time to me, son." Then he also asked, "What's $1,000,000 to you?" God said, "It's only a penny to me, son." So then I said, "Okay, Lord, how about you just give me $1,000,000? "Sure, son," God replied, "but you'll just have to wait a second." Sometimes we have to wait longer than we want, but that's what builds our character and self-control. Children need help to develop resistance. They are by nature impulsive spenders. Self-discipline doesn't come naturally. Every time we say no to our children about ice cream, candy, or a new toy, we teach them something important. In order for things to be special, they must be the exception, not the rule. There are higher values than immediate gratification. There are better ways to use God's money than to follow our own impulses. Children raised this way will usually follow the same pattern of decision-making when they're on their own. Self-control learned by children in one area carries over to others. Children who learn to say no to unnecessary purchases are more likely to say no to immorality, alcohol, drugs, or shoplifting. Children whose parents won't give them everything they want are invariably more content than their spoiled counterparts. They ask for things less often. When they do ask, they're far more selective. When their parents say no, they can accept the no because they're aware that no amount of begging or bartering can get in the way. It will only result in discipline. Children who are used to getting whatever they want continually spend their time sharpening their skills for manipulating their parents. Obviously, parents should sometimes say yes to their children's requests. In the context of good stewardship, giving to our children can teach the lesson of generosity, not indulgence. Tight-fisted stinginess as a negative, a model as indulgence, okay? Balance is the key. Our goal isn't to be penny pinchers obsessed with money and fretting over every expenditure, but joyful, responsible, and generous stewards of God's abundance. The point of being careful with God's money is to free up more resources to be used for kingdom purposes. A wonderful side effect is that it also builds more Christ-like character. When it comes to spending, children can learn to shop intelligently, looking around and not buying the first thing they see. We can teach them how to compare values and discover the best places to buy. To avoid impulsive spending, our family has a rule of not making major purchases unless we've considered it for at least several months. If we still want something 4 months later, it's no longer an impulsive expenditure. I suggest less shopping for entertainment. Aimless wandering through malls and shopping centers produces unnecessary spending. It can breed discontent to look at all the latest models of things that we don't need and can't afford anyway. I recommend a family field trip to a shopping center for a specific purpose, but not to buy something. Look at all the different things, then ask yourself and your children if they're really worth the cost in light of what else could be done with the money, especially to help others and invest in God's kingdom. I walked through a shopping center one day, identifying the products in the stores that could be described as things I needed as opposed to things I might want. The result was more amazing than I anticipated. Other than a few items of food and the most basic clothing, the other 99.9% of the items were non-necessities. When I took our girls on the same sort of tour, their job was to identify needed items as opposed to want items. They had a fun time and came home realizing how few needs and how many wants we have. An effective way to teach children how to properly spend money is to show them how you spend it. By the time the children are 10, perhaps even younger, they're old enough to be let in on the family budget. One technique is to bring home an entire paycheck in $1 bills, or you could use play money to illustrate the same thing. Put the money in piles and show how much goes into expenses monthly. This approach allows children to visualize where the family money goes. It helps them compare what's expensive and what isn't, what's a priority and what's not. Some things will surprise the children and they'll ask you questions that are mutually enlightening. You'll probably reevaluate your budget and make some healthy changes. Comparing the amount you give away to the amount you spend on yourself may be particularly convicting. Your children may see things from a responsible perspective for the first time. Children who have been told to turn off the lights when they leave a room or shut the front door behind them suddenly understand when they see their stack of money that goes to pay the electric bill. Children may hear their parents' words, but until they visualize what they mean, the words don't really sink in. Looking at your tax return helps gauge your spiritual perspective. For example, how much you spend on interest compared to how much you give says a lot about what you believe. Do you take a greater deduction for interest on debt than you do for your charitable giving? Show your children your tax return, not just for their instruction, but for yours. As parents, our ultimate purpose isn't to simply give our children food and shelter for the first 20 years of life. Our purpose is to one day present to the Lord, the church, and the world mature young adults who are servants, good stewards, and good citizens. As children grow up, they should gradually be weaned financially from their parents. Especially as they are nearing the end of high school, children should be progressively earning more money and accepting more responsibility for their finances. By the time they're 10, most children might have their own savings account. By 12, they might have a part-time summer job. By 16, they could have their own checking account. By 17, they might be paying for their own transportation, recreation, some of their clothing. Of course, this will vary a great deal according to family needs, preferences, work opportunities, and a child's development. After they complete high school, as long as our children are still in their early 20s, it may be reasonable to provide their food and lodging, but we must discern when this stops being healthy and starts developing bad habits of dependence that will be hard to break when they finally have to function in the real world. We must also realize that what's good for one child may be bad for another. The goal is to help our children become increasingly independent of us, which should lead to an increasing dependence on the Lord. Dependence isn't eliminated, it's simply transferred. We can entrust our children with more and more financial responsibility. We should find them becoming more and more financially trustworthy. As they prove themselves trustworthy, God will entrust more and more to them as well. Let me repeat for emphasis what I said earlier. We parents should not transfer wealth to our grown children unless we first transferred wisdom. Without wisdom, passing on wealth won't just be wasted. It will damage our children 100% of the time. Children who share, most parents can identify with this lament. We wish Jimmy knew how to share. Sometimes we're appalled and embarrassed by our children's display of greed and possessiveness. We want them to learn to share, yet too often we don't provide them with a model for sharing. Most of us will buy a certain tool or kitchen gadget that we'll only use a few times a year, rather than borrow it from a neighbor. This decision does two things. It results in unnecessary expense and circumvents the development of a relationship with our neighbor that would naturally be cultivated by sharing resources. It also trains our children to think and live independently rather than interdependently. What do our children learn when they hear us complain about the fact that we loaned someone our car and it was returned dirty or dented? They may have even heard us say, "That's the last time we'll ever loan our tent to the youth group." However, if we view our assets as really belonging to God, we'll be glad to loan our car or tent, even though we realize it may come back a little bit worse for wear. But that's part of sharing. To learn true sharing, children must see us do it. We must not just talk about sharing, we must share. Hospitality is one of the strongest ways we can teach our children. By opening our homes to others and being gracious hosts and hostesses, we teach our children both to share and enjoy the fruits of sharing. They see firsthand the value of encouraging other people and drawing close to them through the unselfish use of possessions. You might even look back with your children at some of the people to whom you've opened your home and wonder if, without knowing it, you've entertained an angel in disguise, as it's said in Hebrews 13. Children who are thankful, sharper than a serpent's tooth it is to have a thankless child. Any parent who has one knows exactly what Shakespeare meant. In the midst of abundance, they've always known, and with the sin nature they've always had, our children won't naturally be thankful. We must teach them thankfulness. Praise the Lord, O my soul, and forget not all his benefits, Psalms 103:2 says. As parents, we can lead the way by counting our blessings in front of the children and openly expressing our thankfulness to God for all he's done for us. We must be careful not to nullify this by complaining when things don't go our way. What do our children learn when they hear us say, "What a shame it had to rain today," or "This stupid car is always breaking down," or "That's the second year in a row without a raise"? We often asked our daughters at night to identify a number of things that they were thankful for that God had done for them that day. At first, this may be difficult, but in time it develops a sensitive eye to the ways God cares for us. At the top of the list of things to be thankful for is God himself, our loving Redeemer. Next are the family and friends and the church he's given us, or the people he's put us around. Children can also give thanks for material things, for more than just toys, but for a body that works, a bed to sleep in, a house to live in, for the air, sunshine, rain, the beauty of flowers and trees. They can give thanks for a country in which they're free to worship and share their faith. Giving thanks for all these things draws their hearts not to things themselves, but to the one who graciously provides them. The focus isn't on the gifts, but the giver. Then, even when the body hurts, the bed's hard, or the house is cold and creaky, there remains a constant assurance that God is still there and still faithful. As children develop thankfulness for their food and other provisions, they can learn to see them not as easy come, easy go commodities, but as personal provisions of a loving Heavenly Father. Otherwise, in this throwaway society of paper plates, paper towels, plastic spoons, and disposables of every kind, it's hard to develop a proper appreciation for things. The obstacles to thankfulness are many, yet they must be overcome in our Christian homes, where we're to give thanks in all circumstances, as 1 Thessalonians talks about. Never apologize for insisting that your children or grandchildren develop an old-fashioned habit of saying please and thank you. Children who aren't taught these basic courtesies are being failed by the adults in their lives. Leaving a legacy is also the final thought in this excerpt. Nothing will interfere more with a children's relationship with God, or even prevent them from having such a relationship, than a life centered on things. Our greatest legacy to our children is to help them develop their inner lives, their spiritual lives, their hearts for God. We must intertwine these lessons with the building of strong character, moral fiber, and rugged biblical values that can endure the beatings of a godless, materialistic society. Although many parents will leave their children an inheritance, we can leave them what really matters: a heritage of wisdom and generosity. They can then pass on this legacy to their own children and their children's children. Godly generations and an eternal impact can result from our simple acts of faithful stewardship, not only of money, but also of the children God entrusts to us. And that was an excerpt from the book that I really enjoy and like and have read, by Randy Alcorn. It's called Money, Possessions, and Eternity. I highly recommend it for those of you who are seeking out ways to be good stewards in this life. So that is the final thought of this week's message right before Thanksgiving. Thanks for tuning in to the Northbound Wealth Podcast, and stay tuned next week as we, after the holiday, as we come back and analyze the markets.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.